tracking the traders' acronyms all year, and it is finally time to reveal the winner of 2024. Drum roll, please. Mike Coe with Brave. B for Bitcoin gave him the lead, soaring 122% last year combined with his other picks, real estate, Anglo Gold Ashanti, value, and emerging markets. He was up 34%. Mike Coe, congratulations. You are the winner of the 2024 Acronym Challenge and the recipient, hold on, of this illustrious trophy.
Wow. That's pretty.
2024.
Yeah, Mike. All right, Mike. He's got a spot picked out for it.
You feel good about this, huh? This win, Mike, huh?
Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Apparently there is an award that is handed out for the people who come up with an acronym to describe what their best bets are for each year. And at the beginning of 2024, mine was Brave. If you didn't follow me then, I wanted to discuss this a little bit, not to crow about a victory. We're only as good as our last trade. So to talk about sort of my best bets for 2024, it's a little water under the bridge at this point. But I did happen to observe as I was tracking the performance attribution of that acronym. And James Foreman, I'm jealous of your trophy. You like that acronym with a K? Yeah, it's quite a piece of work, that. And every year, I think they just take a Post-it and put a new number over the last digit. But maybe we can share my screen for just a second so that we can talk a little bit about what was going on with that acronym and how it did. So I was feeling pretty good about my bets for 2024 through the end of the third quarter. And yes, we'll get to what my 2025 acronym is. I see someone's asking about that. I don't know if I can reveal it before I give the reveal on CNBC. I don't think it's going to matter that much. I'm going to talk a little bit about this as a game, but also what was happening here. So one of the things you're going to notice if you take a look at this is basically tracking the performance of the 5 things that I talked about at the beginning of 2024 and how each of these contributed to the performance of that as sort of an overarching strategy throughout the year. And the acronym, if you didn't follow along, was Brave. B was for Bitcoin. R was for real estate. I was actually talking about MBS. So in the context of the conversations we've been having on this live stream about things like MFA, for example, which would be an RMBS play, I was talking about it more generically as an asset allocation, not realizing until after the fact that you actually are supposed to, as part of CNBC's rules on these acronyms, give them a ticker symbol, not just an asset class. But be that as it may, we can use MFA or something else as an example. AU for gold and also the ticker symbol for Anglo Ashanti. V was for value, and what I meant by that was the S&P 500 Value Index, which is also the IVE index. There are a number of ETFs that track it. And E was for emerging, as in emerging markets, and EEM was the proxy for that. Now, what I'd like you to observe here is that for the first 9 months of the year, that is through the end of the third quarter, ending September 30th of 2024, you'll notice that almost everything in that portfolio was contributing in some meaningful way to the overall sort of strategy or portfolio performance, if you will. And after that, something profound started to happen, which is that almost everything other than Bitcoin started to get hurt, and Bitcoin basically carried the day. And this happens to correspond with something else that we were seeing in the markets. Not what this was tracking specifically, but I think something that should matter to folks, which is the relationship, or actually we'll just think about it as bond yields, but I want us to think about it also in terms of the relationship of bond yields. Here we're looking at the U.S. yield versus China. And I'm going to look at this spread right here, because a like folks to pay attention to this, and then we're going to go back to the individual yields on these spreads. So throughout the year, we saw that the U.S. 10-year yield first rose relative to the Chinese 10-year, then it fell, and then from the first week of October through the present day, it has absolutely exploded. And I was having this conversation, and here we can just look at the chart a different way. You're looking at U.S. 10-year yields on the top and the Chinese 10-year yield on the bottom. Ignore this 16.64% and the 35.52%. That's just an artifact of how Bloomberg charting works. It's basically trying to track the percentage change, and it's treating it as if it's a price. We wouldn't normally think about the percentage of a percentage as the way to think about the price change. But it does tell us something about the state of the world. Now, there are reasons that rates can rise that are good. For example, if you are anticipating significantly faster economic growth, then, all else equal, you might expect to see interest rates rise. There are good reasons why rates can fall. If you have a lower inflation expectation, then, all else equal, you would expect to see rates fall. There are also bad reasons these things can happen. Rates can rise because of inflation risks, and rates can fall because of declining expectations for the economy. And what's concerning about this yield spread divergence that we're seeing is that that's really what this was about. The increase that we've seen in rates in the U.S. 10-year recently has been a function of additional concerns about persistent levels of inflation. And the reason that the Chinese 10-year has been falling is because people are increasingly becoming aware that the Chinese economy is under significant duress for a couple of reasons. One of those reasons is that they have a massive amount of debt there. So there is sort of this gray market debt that's sort of not conventional lending, unconventional lending. And a lot of that debt was used speculatively in real estate. And I think a lot of people had gotten the idea that net of the Evergrande sort of collapse that took place some time ago, that problem was largely behind them. But I don't know that people well and fully appreciate the scale and scope of the excess that occurred in their debt markets and in their real estate markets. Partially because it was one of the easy places for people in China to invest. And there's another problem. Well, two other problems, really. One of those problems is a demographic one, which is that it is highly unconventional for an emerging economy to have a population that is, on average, older than more mature economies, like that of the United States. But such is the case in China, and the reason that's true is because of their long-held one-child policy, which has proven to be a little bit of a demographic time bomb for the country. Because what is now happening is that the population is aging, and they have a significantly smaller percentage of younger people to support that aging economy. And, of course, that's going to also cause a significant increase in labor costs, things of that nature, which threaten China's dominance as sort of the hub of all manufacturing for the world, and as their position as the world's leading exporter of manufactured goods. So that is certainly a problem. The other thing is that even with that, so even with the overbuilding of, you would think that under normal circumstances, if you had an economy that was growing more rapidly than the global economy was in general, that had a need or demand for labor, and that had an excess of real estate construction, well, that sounds like a great place to immigrate to. However, China is not a fully free and democratic society. And consequently, it doesn't have quite the same appeal that it does to come to the United States, for example. So I think, this is what we're seeing. I'd like to try to be a bit optimistic about this in the following sense, which is that as far as China is concerned, they, like any economy does when it's faced with a debt bubble, needs essentially to find a way to grow its way out, or to dilute the currency. And either of those efforts, should they succeed in doing them, would actually potentially keep a bit of a lid on inflation in the U.S. because we import a lot of goods from there. So we keep hearing concerns about increased inflation in the United States as a result of potential tariff policy from the incoming administration. But it is worth noting that, we don't operate in a vacuum. And, China has its own economic issues to contend with. And some of its efforts to do that might ultimately be, if not deflationary, at least help offset potential impacts for things like tariffs. So I figured I would mention that. But I wanted to bring all of this up because as we look at this, the last 3 months of 2024, from my view, although this acronym gained, it was up about 24% and change at the end of the third quarter and ended up about just under 35%, I think, for the year. So CNBC's calculations were slightly different than mine. Their net result was the same, but their performance for the fourth quarter, was a little bit different. But one of the things you can see here is that value stocks essentially were, contributing very little by the end here. Gold was contributing less than it had been previously. Gold fell off. That's actually not that surprising. So if you think about it, gold prices, again, we're just going to say all else equal, things to think about. All else equal, if our interest rates rise, then the price of gold would fall. Why is that? Two reasons. One, as interest rates rise, that is partially an effort to essentially preserve the value of the currency, to curtail inflation. So increasing the value of the currency would be a reason that the price of gold in dollars would fall. And the other reason is that the carry cost for gold rises, because if you invest, you buy 100 ounces of gold and you have to store and insure that, the cost of storage, you need to contemplate that use of funds and what it would have otherwise earned. Otherwise, there's an arbitrage, right? So all else equal, we would expect gold to soften in the context of rising rates in the currency to which you're trying to price the underlying commodity. Now, as for Bitcoin, well, that's a completely different matter, and that's because it does tend to track risk assets to a degree. We can see that it fell along with a lot of other risk assets in the month of December. The value component didn't do particularly well, and the RMBS component did very poorly, essentially giving back almost all of its gains. So I think the total return for RMBS for 2024 was, 1% or slightly above, not even keeping pace with inflation. And that's after having been up double digits at the end of the third quarter. And again, the reason for that was rates. As rates rise, then the value of a fixed income portfolio, all else equal, is going to drop. That is what happened. What is interesting about that, though, is that if we assume that most of the rise in rates that we saw has essentially run its course, then that's a place where I think we can continue to play, which is one of the reasons why when we were talking on Monday about MFA, which was a REIT that invests in RMBS and also some other real estate related lending, might actually still be a decent place, and I agree with it. So that's VICI Properties is another one. Now, somebody asked, and I'm just going to follow up on this question because someone was asking about O REIT. So that's REIT O, ticker O. Right here. Let's pull this up so you guys can have a look at it. How I feel about this one relative to, say, an MFA or a VICI The issue... So one of the issues that this one has is, all of these REITs have little elements that are going to be slightly different. VICI is a REIT, but it's, managing properties. MFA is a REIT, but it's investing in fixed income around the complex of real estate lending. O has a lot of exposure to triple net leases. And I'm not going to pretend to be an expert on all of the dynamics for triple net leases, but I can say that there are some who cover the space who are less optimistic about it at this time. So, faced with a choice, you're going to say, okay, would you rather O? Would you rather MFA? Would you rather VICI Properties? The answer, I would rather VICI Properties or MFA than O. So, to answer that question, I hope that helps. Okay. All of that said, let's move on to some other questions here. And actually, there was one that I think FinWest had. I don't have it in... okay, I think someone's going to be able to bring that up for us. So FinWest asked, skipped over my comment in the live stream, so I'll reiterate it here. I appreciate the education and market wisdom, so hope you'll be continuing this content going into 2025. So do I. And thank you all for joining. And the more of you who do, the more likely we can keep doing this. So, like, subscribe, notify your friends and relatives, anybody who would like to watch. We always welcome more viewers. So, I added VICI to my dividend portfolio last year and appreciate its contribution to my income. You reminded me I should buy some more. Yes, so like I said, I do like it. As for TLT, I started a covered call strategy to see if I could beat the performance of TLTW using my own method of selecting the strikes. So far, I'm ahead by almost 1%, 100 basis points. 100 basis points, by the way, folks, on an instrument like TLT, that is meaningful outperformance because the yield on TLT isn't huge. So, in fact, actually, why don't we just see where it is as of today's close? 4.9%. So, if you can squeeze an extra 100 basis points out of TLT within a given year, you have done a remarkably good job, I would say. And also in an overwriting context, remember that TLT is a relatively low volatility instrument, so the premiums you're going to collect are not that great. And also remember that the price of calls relative to puts is impacted not only by the prevailing level of risk-free rates, but also just on carry cost. So if these were zero coupon bonds, and then there would be no distributions, there would be no dividends from the ETFs or coupons if you happen to own the bonds, then that wouldn't be an impact. But in this case, there are. So when you do get distributions, then all else equal, call premium will go down, put will go up to account for that. And so, again, the amount of incremental yield that you're going to be able to squeak out of selling upside calls against it will be slightly less. So 100 basis points, I would say, I don't know over what time frame you were doing this, but I would say that that's very good and very well managed. And I don't have an issue with that either, because to anybody, if you ever have a directional view where you feel like you have some edge, I'm not saying I have a directional edge on rates. I do not. I'm not a rate trader. Obviously, everybody's a rate trader to the extent that we put on positions that are going to change in value as a function of rates. But, I don't consider myself a rate specialist. But my point is that if and as you ever feel like you have some insight or feel for the price action of the underlying asset, and you want to incorporate that into your selection of short or long strikes in your options trades, by all means do it. There are people who have a better sense of it. And the other thing is that sometimes you're going to do that also because of a level of comfort. An example would be, this is totally random, I'm just going to bring up Unitedhealth, for example. Unitedhealth and Humana, I've mentioned before that this is a hard hit space, and I think a week or two ago I was saying that I'd actually be a buyer of these names here because I feel like they're a little bit unfairly beaten up. Obviously had a lot of bad news. Not necessarily, I think some people thought that the incoming administration might be unfriendly, but the fact is that these stocks are about as well priced in terms of valuation as they have been. And So if you are in this situation and you notice that volatility is going up, which it did, and you wanted to sell downside puts because you are more bullish on the stock, and you had an opportunity to sell it around 30 vol or so here, obviously it got much higher right after that event, by all means. And that's actually 3-month vol. So that's another thing. If vol goes up and you're a vol seller, sometimes you should feel comfortable taking advantage of that short-term anomaly. This was an idiosyncratic event, let's hope, right? So I certainly would expect and hope that it's not going to be commonplace that publicly traded, that the CEOs of major subsidiaries of publicly traded companies are going to be assassinated on Manhattan streets by nuts who have an axe to grind. But my point is understanding that that was a unique situation and that the options premiums boost that happened was probably going to be relatively short-lived. That's when you can extend the short premium bet because, maybe a little bit longer than you otherwise would. I typically like, a month, 45 days, maybe 2 months to sell premium. Usually like to avoid selling premium through earnings, for example. This would potentially be an exception to that because why premium's been elevated. It's because something dramatic has happened, but that doesn't necessarily mean that that's going to impact the stock longer term. So in this is another example where, choose your own strikes. It doesn't have to be systematic because that the stock has fallen because of this unusual event. That vol has popped because of this unusual event, and that this too shall eventually pass as far as the company is concerned. Take advantage of that. Okay, so let's move on to another question. I always hedge in my options account SPY, SPX, triple Qs. I also have a futures account. What's your preference for a substantial account? So I use SPX options myself. I like SPX options, NDX options. I actually don't trade NDX options that often. I just think in S&P 500 terms, and so that tends to be where I just gravitate naturally. I prefer SPX and NDX options, and you could do this on Russell options as well. I prefer them because they're cash settled, right? So that's a convenient feature because you don't ever have to, I've seen some wild things happen when people unknowingly take assignment because they were, unable to do something about it. Cash settled options are very convenient in that way. So that is usually my preference. But if you're also trading the futures, then why not, right? So if you have a big futures account, you're trading a lot of futures, I don't have any issue with that. I've traded plenty of futures options as well. Obviously when I was on the NYMEX and I was trading oil and natural gas, I was only trading futures options. So that's totally fine. And I was only trading the natural gas futures and the oil contracts. So I think it just sort of depends a little bit on what you're using for your underlying asset. If you're hedging and trading with futures and you're in your futures account, why not? Scott Nations, who used to do the Options Action Show with me for a number of years, he was a CME guy. He traded S&P 500, the big contracts, the futures contracts, but he was a CME guy, right? So that's what he made a market. We all have kind of our way of thinking about things, but in general, for broader index stuff, assuming that it doesn't create a notional problem for you, I prefer the cash settled instruments. So that's my 2 cents on that. I hope that helps. Okay. Ranjana, today I sold a Jan regular way 67.5 put on eBay for 55 cents. Was this a good trade? So, a couple quick points on this. Obviously, I don't know if everybody saw this, but there was news on eBay today. So, the stock did pretty well. The news on it, wow, it's up even more than so I had a phone call at the end of the day. I didn't see what had happened, so it obviously traded really well throughout the close, up 10%. What was the news? And that news was that Facebook Marketplace is looking at working with eBay. And yeah, I view that as a significant positive for eBay. So I think that's all good. And let's talk a little bit about your trade specifically. So for me, it's less common to trade the really short dated stuff this way unless I get about 1% of the underlying. So I have kind of two rules of thumb about this, but I will say that in general, there's something I do like about what you're doing. So the first thing is when you sell puts on a stock or an index for that matter, you are taking equity-like risk. And if you're going to take equity-like risk, then you want to get equity-like rates of return. What is an equity-like rate of return? Well, for a very long time, I think people would have reasonably said that the stock market is going to give you total returns of 7 to 10% a year on average. Then it was 12. More recently, it's been substantially more than that. But for me, I've often thought of it as 12%. Why? Partially because it's pretty close to the longer-term average, excluding the most recent couple of years. But also because it just keeps the math easy, 1% a month. So what I like about what you're doing here is that you are trying to, when you annualize it, get a rate of return that is commensurate with the equity risk that you're taking. So we're going to put this in here. You were selling the Jan regular way, 67 half puts. And at, what did you say you got for those? For some reason, I think 55 cents? No, that can't be right. I'm assuming. Oh, that helps me. There we go. Yeah. Okay. There we go. So 55 cents. So these expire in just 9 days. So how do we think about this? We say, okay, well, 55 cents versus I'm going to use the strike for the risk because that's really the risk you're taking, that you're going to own the stock at 67.5. So that's 81 basis points over 9 days. So we divide that by 9, multiply by sort of the financial convention of 360, gets you to 32.4% annualized rate of return. So that's fine. Just a couple quick things I want to point out for anybody who's inclined to do this. Obviously, you want to manage these short-dated trades because things can change very quickly. Bid-ask spreads, not a problem in eBay because the thing trades in pennies. But if you're going to start selling short-dated premium on some stocks, if the bid-ask spread is wide, meaning that you might be in a, let's say suddenly something reverses or the market starts to roll over, you want to unwind it, the bid-ask spread is wide, I'd be less inclined to do a trade like this, but I'm fine with these kinds of strategies. I rather like them. I'll give you a brief anecdote as a way to think about selling short-dated premium and whether or not there's any good returns to be had in it. I won't mention his name, but a professional friend of mine who used to run the single stocks derivatives business for a very large bank. So we're talking about a top 5 bank in the world. Told me that and I may have told some of you this story before, told me that in one of their better years, 65% of all of the revenues that came from listed single stock options trading by the bank came from selling weekly options in Apple. So there's a huge demand amongst day traders who are speculating on direction to get a lot of leverage to the underlying stock, and oftentimes they trade short-dated options to do this. Now, there can be circumstances when there aren't a lot of buyers and you're going to see the term structure. Let's look at the term structure really quickly. Gets really inverted. Hang on. Why is that typing? Okay, so let's just take a look at the term structure here very quickly. Whoops, that's nice typing. Okay. All right. So what you're trying to take advantage of is this dynamic right here, right? So when short-dated options premium gets really elevated, as today's, so for the end of this week, really went through the roof, and it went through the roof because we had this new news out. But the interesting thing about that is that once that news comes out, you often have this brief window where you can sell that elevated premium. And actually for Jan 17, this is the one that you sold, right? We could actually put in the exact strike if we wanted to, so I could actually put that. Oh no, it's not allowing me to put the strikes in. Usually there is a separate function where I can do that. But if you can imagine what this term structure would look like normally, so we've got earnings going on over here, this would normally just be downward sloping all the way to the front, theoretically. But because of this event, you're sort of taking advantage of this short-term pop in the premium, and also the fact that people use it as a day trading instrument. So I like the strategy, and I like the rate of return that you got, and I like eBay. So all good. Although I will say, call spread risk reversals are, and I realize this is going to seem a little bit confusing, but just take my word for it. A call spread risk reversal is really, in some ways, it's also just selling puts, right? Because you sell a put and you buy a call spread. What you're doing, though, is you are manipulating, let's see if I can get over to that. You're essentially manipulating where the payoff takes place. So let me see if I can provide an example of what that looks like here. So I'll modify this one. We don't need the stock. So put in a couple calls, put in a put, and I'm just going to leave this as, I'm going to put in February regular way for the sake of argument. Doesn't really matter. So we're going to say buy the at the money call. We will sell we'll call it a 75 call, and maybe sell a 65 strike put. Okay. So here is a short put, and actually I'm going to go out to February so that we can just get a better look at this, because I realize this isn't intuitive necessarily, but it's just something to think about. Now, okay, so this is selling a February 70 strike put. It's almost where the stock is now. We'll say you're collecting about $3 on $70 worth of risk. Remember that I like to sort of divide that premium by the strike usually. And now compare that to, just look at this shape for a second, and now compare that to this, okay? And so the shape of this is similar. It's just got this bump in it here. What you have done is you have exchanged some of the premium that you would collect at spot on a standstill basis for slightly less risk to the downside and slightly more participation to the upside. So you're just basically squeezing that same, but the general position is going to behave in a similar way. And why is that? Because with a call spread risk reversal, you're short two options, long one, net short one. And in a short put, you're net short one. And in both cases, you have a limited upside and risk all the way to zero to the downside. So when you are playing with these strategies and you're thinking, okay, what's the risk characteristic of them? Just understand that these are kind of similar things. And I talk about call spread risk reversals all the time. So I would be a hypocrite if I said, oh, I like call spread risk reversals, which I would in a case like this. Why? Because you're looking at a situation where the stock just jumps 10% on new news. You want to be able to participate because you think it's a good thing, but you're reluctant because you're afraid it's just going to give back everything that it gained today. So I do a $5 call spread risk reversal. Of the $6 and change that it gained today, I'm basically not risk for the first 5 to the downside if it gives that back. You know, if people come out and say, actually, I don't really see that this is going to be as meaningful to the company's fundamentals as the stock price change might imply, that's why you would do that. But I think of all of these strategies as being vaguely similar. A covered call or a buy right, a short put, call spread risk reversal. All of these are going to have risk characteristics that are kind of similar to selling short puts. But in general, that's not a bad strategy, right? So that's fine. Okay, next question. eSmith 23, nearly 40% drop in IONQ today has wiped out all the gains I had. Thoughts on playing for a rebound in quantum computing stocks? Maybe too soon. Yeah, so Jensen at NVDA, he came out with these comments where he basically said that people are anticipating the onset of quantum computing way too soon, and that, he said, maybe 20 years is when people could reasonably expect practical applications of quantum computing to apply. I'm not an expert on quantum computing. I did attend an event where quantum computing recently was, one of the key topics that was being discussed, and I had an opportunity to speak to people who are in the space, who are investing in the space, and their arguably more optimistic timelines were certainly faster than what Jensen said today. In fact, the shorter end of that was 5 years. So they were saying 29, 30-ish, maybe, is when you could see this really start to come to the fore. That was the earliest part of their time horizon. Even they admitted that was probably optimistic, but they were just trying to give a range. I did not hear anything that went out to 30 years. So at that event. So that suggests to me that maybe Jensen's a little more pessimistic than some within the space are of quantum computing. But there's something else I would like to say, which is that, of course, where investors are concerned, you're always anticipating what's going to happen. People were not buying NVIDIA through the course of this last year or the one before and so on by what the company had already done, but what it would do. And this will also be true, even more true, when you're talking about the advent of technologies that are completely novel, as quantum computing is and will be. So my expectation is that quantum computing stocks will recover long before quantum computing is actually being used in practical applications. So, IBM's second quantum machine, which is quite if you can find a model of it, I don't know if we can find a model of it and look at it. It almost looks like a piece of art, I have to say. It's quite a stunning structure. It's not, you open up the back of your computer and you kind of have a vision of what these things look like, and quantum computers don't look, the first models of these things don't look anything like that. And the amount that they have spent for the relatively limited capabilities that they have is astronomical. I think they said that IBM spent something like $1 billion on the second model that they have. But I fully expect that the stocks will recover well before you have practical applications of quantum computing. They're going to trade on the promise of it, not the delivery of it, which is how investors should invest, right? You don't get to buy a dollar for 80 cents with the dollar already in hand. You can pay 80 cents for a dollar that you may receive in the future. Anything other than that would probably be some kind of an arbitrage situation. So anyway, let's see. I saw the end of Fast Money yesterday. Congratulations on your 2024 acronym win. That trophy, the trophy with the scribbled. Oh, it's over my shoulder. Oh yeah, there it is. Yeah, that's quite a beauty, isn't it? Okay, Steve Garcia. Hi from Marin County for weeks and months. Johnny John, that's what we used to call it back on the trading floor in the late 90s, has been trading in a steady downward channel. Thinking of a long position, either buying shares for the dividend or a July 145, 155 call spread for 325. Comments. Yeah, it has presented itself as a little bit of a value trap, I guess. I think this was actually one of the names we had on the specialist book. This is, as I think I've pointed out in the past, this doesn't sort of come to the top of any screens that I normally do, generally because the top line growth is not that great. So the expectation for top line growth this year is 2.8%. That said, EPS growth is okay. 3% is Well, let's hope that that's not keeping up with the economy. My hope is that we get more than 3% GDP growth in 2025, and I think we will. But you have tremendous free cash flow here, and it's trading at a relatively low multiple. And a lot of the goods that they sell are just staples, right? So one of the things that worries me in many cases when you're dealing with drug companies is that they are dealing with patent expirations and things like this, and they just don't get a good pipeline of replacement drugs. This is not an issue when you're talking about baby shampoo, one of the products for which Johnson & Johnson is most famous, or bandages and things like this. So as far as I'm concerned, I think this one is fine. I think one of the things we should probably take a look at here is what the technical setup is. So give me a second while we look at this together. Obviously, the stock's weak performance. So when you're taking a look at this ranking over here, so if I just take a look at the top ranked strategies, it's actually kind of an even bag between wins and losses. But part of this is going to be because since the stock hasn't performed particularly well of late, most of the longer-term bullish strategies, and when I say longer-term, I don't know that I've shown this before, but it's probably worth just paying some attention to it. Let me see if I can blow this up a little bit. So in these columns, one of the things you can see here is the age of these trades. So some technical indicators have a longer time horizon than others. Carter Worth of Worth Charting, friend, colleague, his time horizon is usually 60 to 90 days, whereas many of these other technical indicators have very, very short-term trades, and they tend to have, a very active trading strategy. But some of these are going to be, a little bit longer. So, my attitude about it is, yeah, I'm okay with Johnson & Johnson. By the way, if you sell downside puts, you will also sort of be collecting some yield. Not a great looking chart, in fairness. But, I would also say that from a valuation perspective, I don't think it presents a great deal of risk. So this might be a suitable one for something like that wheel strategy, a situation where you say, okay, I'm going to start selling perhaps the 140 puts. If the stock gets put to me, then I'll sell some calls against it. If it gets called away, and so on. Bearing in mind that any high dividend paying stock, you're at a greater risk of having it called away from you prior to expiration if you ride a short call through the ex-dividend date and it gets well in the money. What's the math you need to do just to think about this? If the net present value of the dividend that you would be entitled to receive if you own the stock on the day prior to the ex-dividend date, obviously the day of the ex-dividend date trades without the dividend, so you're not entitled, is the extrinsic value of the option needs to exceed the net present value of the dividend. And in the case of Johnson & Johnson, the quarterly dividend is $1.24. And this is a low volatility stock. So it doesn't have to travel too far through these call strikes before you are at risk of assignment if you're long the stock and selling a call against it. Although you had actually said you were thinking about buying a call spread, that's another thing to remember. If you are long a call spread and you let the stock run through your long call strike, ask yourself before the ex-dividend date, which for Johnson & Johnson is going to be, well, the next one, so let's see here. So the next ex-dividend date is February 18th. So keep that firmly in mind if you're going to, do anything that involves calls in and around. This is not really an issue for puts, but it's, much more something you need to worry about on the call side. That if a call strike is in the money and the extrinsic value of that strike, which you can calculate by looking at the value of the put, that's like a crude back of the napkin way to do it, is greater than the dividend. So why don't we work through an example here really quickly and we can just think about that. We're just going to look at today's closing prices for this one, and we're going to use January options. Now, bear in mind, there is no ex-dividend date affecting January, right? So it's February. But I just want you to think of which calls would be an early exercise candidate in the context if the stock was going ex-dividend and these were the prices that you saw. So if the stock was going ex-dividend this week, and we know that the dividend's $1.25, then anything where the extrinsic value of the option is less than the $1.25 that you'd be entitled to if you get the dividend, that's probably going to be an early exercise. So that would include maybe the 141s. It's awfully close. This thing's worth about $1.20, so a nickel, maybe they would, maybe they wouldn't. But the 140s certainly would be an early exercise candidate. Anything below 140, those calls would be an early exercise candidate. Other things you can look at. And, oh, by the way, look here. So you see that there's over 1,000 open interest. What will happen on the day before a stock goes ex-dividend is you're probably going to see a lot of these things trading. If there's still this open interest on a strike that's a couple dollars in the money, and you're saying to yourself, why is there all this call volume? And why is all of it in the money? That seems so weird. What's actually going on is dealers, so this is going to seem, it's a little inside baseball here, but dealers can actually be up and down in the same strike. You can have opening longs and opening shorts. That seems probably, how is that possible? But trust me, there's sort of mechanical reasons why this is true. So as market makers, it was very common for us to do dividend spreads. So I would trade 1,000 call spreads with the guy next to me, and and so on and so forth. So we would trade thousands of these things. And we would exercise all of our long calls and then wait to see what we got assigned on the short ones and see how many we, quote, got away with. So effectively, the difference between that extrinsic value and the net present value of the dividend was how much you would make overnight on any call that somebody didn't bother to exercise early the way they should have optimally. That's what's going on. And the reason market makers can do this and retail can't is because on most exchanges, there are caps on the amount of fees that market makers have to pay to that relevant exchange. And so consequently, it didn't cost us anything to do it. We would just trade the things at fair value, up and down, back and forth, and then exercise our longs. And actually, there was one day when we had a newbie in the crowd who saw everybody trading these things back and forth, didn't really know what was going on, and somebody asked him, I don't know whether I was one of them, but somebody said, oh, do you want to trade some of these call spreads? And he saw everybody else doing so he said, sure. And the next day, everyone had to compare notes. Even though we were competitors, ostensibly, we had to compare notes, and it was kind of an honor system. Whoever got away with the most of them had to buy lunch for the whole crowd, because you basically, it was windfall profit. So, you walked in one day and suddenly you made 10 grand. So, buy lunch for the crowd. So the next day, everybody came in and they asked the new guy, how many did you get away with? And he said, what do you mean? He didn't know what we were talking about. He didn't exercise his long calls. So he lost quite a lot. We never saw him again. Anyway, I'm sure my crowd was not the only one where such a thing has happened. But that was, felt bad for that guy. Okay, so we just answered the Johnson & Johnson. Congrats on the CNBC challenge. Jealous of that trophy. Yeah, real beauty. And as Tucker D. Dog said, with respect to quantum 20 to 30 years out, that is on the long end of the expectation that I am hearing from people who are in it. And as Tucker D. Dog says, read that as NVIDIA's quantum efforts are 20 to 30 years out. So this is an interesting thing. It's probably worth mentioning that quantum computing does not eliminate the role of conventional chip makers. So, and again, I'm not an engineer in this area, but I saw how some of these machines were constructed, and they pointed out that actually conventional chips have a role in quantum machines. And obviously a lot of the existing makers are going to start pivoting their technology in that direction. So my expectation is that there is going to be a role for these companies in that eventually. Okay. So Alex V says, and I realize I must have skipped over this one, just realized that OEF outperformed SPY last year. Yeah. It's funny. Nobody really talks about. It used to be the big thing, right? The OEX. That was actually on the index side. That was when I first started. The OEX was the big index pit on the SIBO before SPX. And I don't remember exactly when that switched, but that indeed was the case. Could partially be because in the early days, it was just a whole lot easier to deal with an index with a smaller constituent set. OEX is 100 stocks versus 500. But I don't know that it really matters that much these days. And the reason I say that is because the top 100 stocks in the S&P basically are the S&P. If you take everything below that, take a look at the percentages here. I mean, Lockheed Martin is the 100th largest constituent, and it's 1%, and you start dropping below 1% once you get down to so these things are all puny pieces of all of this. It's really all of the it's not even 1%. What am I talking about? It's 1% of the outstanding. So the 100th largest one is it's 20 basis points of the index. These things all barely even count. 1 basis point of the entire index for News Corp, for example. So that reason, where the OEX was sort of 100 stocks, the S&P is kind of 100 stocks anyway, as we think about it. So there is that. All right, let's see if we have, let me just refresh this, see if we have any other questions. Your trade on, congrats on your CNBC first rank. Your trade on Google have May 200 calls and short Jan 190 puts, so you got a risk reversal on. Short, wait a minute. You're short a strangle, okay, and bought back the short Jan 210 call. I'm bullish on Alphabet. I think they're in several areas that have secular tailwinds. They do have some challenges. Ad spending is a potential challenge. Netflix is a little bit of a challenge on the YouTube TV side, especially with the sports that they're taking in now, because I kind of thought YouTube TV, when we got their Sunday ticket thing, I thought, boy, they've really figured this one out. But Netflix is obviously bidding up some of that content. I still think the YouTube TV is a better product for that use case. But, you can't, competing against Netflix in the streaming space is a real challenge. But otherwise, they have the secular tailwinds. They're in AI. They've got the cloud piece. And they trade at a discount. Alphabet trades at a discount to the broad market in terms of multiples, has huge free cash flow, has not levered their balance sheet the way others have. I mean, now they can't really. So, I'm not faulting Apple for having done it, selling tons of long-term debt. By all means, they could and they should. This is the one thing. I don't know if you can see this here, so that the forecast for these revenue declines. But I will tell you that one of the things that has really impressed me about this company over the course of the last several years is that the street has pretty consistently underestimated the revenue picture for Alphabet. All of these growth numbers that you're seeing here, 23%, 18, this is, we're talking about 2020, awfully tough year, up almost 13% year on year revenue growth, 40% the year thereafter. Almost always they seem to be beating the sell side estimates on the top line. And this is one of the reasons why I've kind of liked it for quite a while. And it trades at this cheaper multiple because everybody's always pessimistic that they're going to have this big shoe to drop, largely because of forecasts that the top line growth is going to slow, and indeed it probably will from every now and again. But in general, their top line performance has been better than expected, and their bottom line has been great and their free cash flow yield is phenomenal. I mean, we're looking at $75 billion full year, $92.4 billion for next year, so 4%-ish free cash flow growth for a company that's got $70 billion in cash. It's a pretty good picture. So Tucker D Dog says, let's support Mike in 2025. Click the thumbs up. Yeah, please do that. Comments, all of that stuff really helps. And, one of the things I think we're probably going to try to look for this year, if we can find it, is a sponsor. That would be great if we can find one. And assuming we do, then we can also try to make an effort to get more guests on this thing. And there's a lot of people that I know in the business that I feel like we don't hear enough from. Arguably people hear too much from me. I mean, I'm jabbering on CNBC quite a lot and doing this for a couple hours a week. But there are a lot of people whose voices I think are underrepresented. It would be great to have them on here. And if we can build up a little bit of an audience, they're probably going to be interested. Okay, so with that, I think I have chewed up the better part of an hour. I want to thank all of you guys who tuned in for doing that. For those of you who are jealous of that trophy, you will notice that it looks like something that your 5-year-old could probably make at home with a couple of crayons and some scrap paper. So if you really want one of your own, have at it. With that, like, subscribe, notification bell, all those good things. And we will see you when we do the next one, next Monday, 4:15. Thanks for watching.